Hello and welcome to our September market update. My name is Doug Johnson. I'm the Senior Investment Strategist here at HCM Wealth Advisors and CPAs. And today I'm joined by my colleague, Dan Rinck, who's also an investment strategist with the firm and a member of our investment committee. Dan, how are you?
Good. How are you?
I'm doing all right. Um, Weather's changing a little bit. Leaves are changing a little bit. Market not really changing that much since we saw that big drop in April. So can you give us a little bit of context and color as to what might be going on underneath the surface?
Yeah, absolutely. Yeah, I mean it's been a pretty calm summer, calm start to the fall for the equity markets. This is really just a recap of where we're at year to date with various indices on the equity side that we track. And again, this is the full year. You can see the kind of tariff tantrum drip or tariff tantrum earlier in the year dip from the market. That was the announcement of the tariffs, and then the 90-day pause really marked the bottom of that. Um, but again, so far year to date, up until right now, we're looking at some pretty strong equity returns. So the asset classes I'm showing here are the S&P 500. That's kind of the baseline there. That's that solid black line. And then we have international stocks, we have emerging market stocks, we have value stocks, growth stocks, and small cap stocks. So going across the board here, the two lines at the top there, those are your international stocks. So earlier in the year, there was a very strong international rally. Both broad international and emerging markets significantly outperformed domestic markets. Um, so right now, I mean, you wouldn't expect it, but international is returning close to 25% year to date. Um, so and most of that return came earlier in the year. Since kind of the tariff pause, internationals lagged slightly, but they made so much of a gain earlier in the year that they're continuing that outperformance through the rest of the year. Um, and then if we go back to the domestic markets, you have the S&P 500 there in black. The only thing really outperforming it is growth. So a lot of that can be attributed to, all the AI craze. But even then, the S&P is just slightly behind it, small, low double digits. Below that, you have value. Value has lagged a little bit. There's been fits and starts where value has outperformed, but for the most part, that AI kind of craze is a little too strong and definitely showing some outperformance. And then you have small caps there at the bottom. Again, positive year for small caps, but similar to value, there's days of outperformance, and it seems like they're putting in a solid footing, but then the S&P and those stronger growth names just kind of take over. So again, positive equity returns throughout the year. I mean, if you look at that moment where the tariff pause was initiated, it's been smooth sailing, a steady rise throughout equity markets across the board. So,
And just to interrupt real quick,
yeah,
just a quick commercial for diversification here. Um, we talk about international and how well it's done this year. Granted, as you mentioned, U.S. has actually outperformed since the
yes,
dip in April. But if we rewind all the way back to the beginning of the year, you had, I want to say, 95% of Wall Street. Maybe that's aggressive, but I think it's probably pretty close that we're making the argument that you should own no international
yes.
based on tariffs.
Yeah, you had the all the tariff prospects, and it was the international is going to be uninvestable. Nationalization in the United States, that's where you want to be. And well, the market
Yeah,
proved them
look what
wrong.
happened.
So
So, all right, that's my quick diversification commercial. Back to
absolutely.
the regular scheduled programming.
Yeah. And then on to the bond side, the much maligned bonds. Bonds have put in a very strong year. They've been, as you can see, much more volatile just because rates have really been bouncing across the board with, inflation expectations. What is the Fed going to do? What are the impacts of tariffs going to be on inflation? So you really saw rates bouncing across the board quite a bit earlier in the year. As of late, inflation seems to be more in check. We're getting some more certainty around what tariffs are actually going to look like, and it's not the consensus isn't going to be a significant additive to inflation. So you've seen rates drop. Um, on this chart here, we have TLT, which is your longer term treasury bonds. You have HYG, which is your high yield bonds. SCHZ is that I can't even see what color that is.
We'll call it a royal blue.
A royal blue. Yeah. That's kind of our aggregate, S&P 500 for bonds, that benchmark, and then LQD is corporate bonds. And that black line there is if you would have invested in the money market throughout the year. So again, positive returns across the board. You've had rates really starting to fall as of late as these inflation expectations are getting under control, and bonds have definitely benefited. Again, corporates are up very strong in the eights. High yield, the ag, they're all sitting around mid 6% returns year to date. So again, strong equity market returns and strong bond returns so far this year. Um, and then the asset getting all the headlines lately, seemingly is gold. So gold has had a fantastic year so far. On this chart, we have the S&P 500, we have our bonds, we have our international stocks, and then that purple line at the top, that's gold. So, gold, we're looking at very strong returns year to date. The uptrend is continuing to be very strong. There seems to be a lot of demand for gold. We have a gold position in our portfolio now. It is a small position, but it kind of fits with our overall fixed income strategy with diversification there. But yeah, there's been a significant bull market in gold. It's not showing much signs of slowing down, but definitely wanted to point out that you're going to see a lot of headlines in it because it is continuing to just be very, very strong. All right, and then what has been driving the equity market so far this year? So this chart shows high beta versus low volatility. So your, more growth sensitive stocks versus your, stable stocks. The high beta stocks are putting in, new highs, new highs, new highs. That means there's a big risk appetite in the market. Um, Usually when there's some indigestion or the market is starting to pause, you'll see those low volatility names catching a bid against our high beta names. But you're not really seeing that now. You know, Risk is really driving the market, showing that people are comfortable investing in stocks, which is a good sign. And that lower chart there is low volatility versus the S&P 500. That goes back to 2020. So these lower volatility names are continuing to be cast aside for the broad market and these higher beta names, and that, you know, is a really good sign for the strength of the market. Once you start seeing these low volatility names starting to catch a bid and starting to outperform, that's when you can worry that, these big institutions are taking money off the table and, really kind of managing their risk a little bit better. But at this point, from a from a market strength perspective, we are, looking like we're in a pretty good spot, even to continue throughout the rest of the year and into next year. And then, if we're looking at kind of our canary in the coal mine, which is, the bond market typically tells us when there's stress first, um, there's not much stress at all. This is the investment grade credit spreads. So basically, um, how much investors are willing to pay for the yield that they're getting. So typically, when the market sees very stressful times, and people start selling off, and there's some risk in the market, you'll see these credit spreads blow out. And basically saying, I don't want to hold risky bonds anymore. I want to hold treasuries. So I want to be compensated more for holding these riskier bonds. But at this point, investors are taking on very little compensation for extra yield. And that basically tells us that under the surface, the canary in the coal mine, there's not much there. The bond investors haven't really been signaling us that there's some issues with the underlying economy or the underlying market. So, if we're looking at so far how we've done this year, prospects for the end of the year into next year, there's not much stress so far.
Yeah, we've
Yeah, go
heard,
ahead.
we've heard people talking about, a bubble, so to speak. You've heard a lot of comparisons to time periods like 2000. I think that's probably more to do with the fact that tech is the leader now, and it was back then, but also some comparisons to '08. So, I mean, I guess from a bubble standpoint, are we seeing things that would imply that there could be the possibility of a bubble?
Yeah, I mean, if you look at the concentration, we've talked about concentration for a while now. It keeps getting more and more concentrated. So this chart here is the weighting of tech as a percent of the total US market. Um, Tech is becoming bigger and bigger and bigger and a larger portion of the investable market, and it just continues to do so. It's hard not to point to 2000 there. So 2000 was the big tech bubble. Basically, everyone buying anything that had .com on it, sending the tech weighting the S&P 500 to massive levels, and we are we are there now. Now the environment is a little bit different now. You have globalization. You have most of our lives based in technology, so you can justify it. Um, but at some point, this has to change, right, Doug?
Yeah, I mean, I would say so. I think the main difference between now and then is the fact that these companies at the top, they make a lot of money,
They're making money.
and
Yes.
they're even starting to, in some cases, transition into. I don't want to say they're fully considered value plays right now, but there's a few names that if you bought a quote unquote value ETF, you would probably see some of those in there. And they're trading at, what I'd say reasonable valuations. And they're even starting to pay dividends, some of them. So, I do think there are some differences, that being the main one. But yes, when you look at the market and see the level of concentration we have at the top, you would think that at some point there has to be some resolution to that. And that either happens with the rest of the market catching up, or those quote unquote generals at the top, falling off at some point. But not only that, I think there's other things to look at too. I mean, here's the top 10 stocks in the S&P. The contribution of market cap gain since 2021, over half of it, just by the top 10 names. I mean, that's an enormous number. And I think there's probably a corresponding chart here uh, that shows the percentage of the earnings growth, probably also coming from these names as well. But I think there's probably positives and negatives, for this concentration level. But it's interesting to see that these names have driven so much of the return for the index. And I mean, another portion of a bubble is euphoria, extremely greedy sentiment, we'll call it. But Dan, when we look at this, you don't really see it.
No, you don't really see it at all, and that is something that I've been looking at all this week. So you've actually seen numbers of, retail investors having net equity reductions. So their retail investors are net sellers at this point. So you're seeing people look at this and say, oh, it feels a little risky. I'm taking money off the table. So you have the individual investor saying, I'm a little worried, I'm taking money out. But institutional investors are actually are net adders of equity exposure right now. So from a sentiment standpoint, you're not seeing anything that tells you that we are in a crazy euphoric phase right now. Now
Yeah,
there's going to be sections of the market where you might be able to make that argument, but the market as a whole, we're not seeing anything that would tell you that people are putting way too much money at risk than they need to
sure.
be.
And historically, we're entering that period of seasonality where the market has seen a little bit more volatility than normal. And I think you're now going to have some of the economic drivers coming into play, which we're
Mhm.
going to talk about in just a second. But yeah, I mean, underneath the surface, this market has remained extremely resilient in the face of a lot of concerns. They say that the market climbs a wall of worry. It seems like it's doing that right now. And from a quote unquote bubble perspective, I would agree that we're just not seeing that right now. I mean, doesn't mean we can't have a 5 or 10% correction, but are we going to have a 40 or 50% drawdown? It's just there's nothing that would back that up right now. And when you look at how this market has done in this bull market cycle, I mean, here's a chart that shows pretty much every bull market um, in history. Maybe not in history, probably going back to, well, yeah, I mean, I see a March 26, August 29 here. So this goes
Yeah.
back close to 100 years. And the path of this bull market is pretty much right in line with, we'll call it the average return of what we've seen. You've still got a lot of lines that are above that and not many below it. So it feels like this thing has been really, really strong, but based on history, it's
Normal.
kind of hasn't been.
If you look at the last 3 years, you wouldn't expect it to
Yeah,
be perfectly normal, but
which is surprising, but
yes.
again, well, what happens going forward, I think, is going to be dictated by what we're about to talk about here. So, um, we've probably beat the tariff topic to death. You'll notice that I didn't put a tariff chart in here because I don't know what there is to talk about. And I say that somewhat tongue in cheek, but the tariff situation has changed so frequently that it's hard to even look at it and try to map anything out. What we saw in the beginning, where you had the market essentially selling off because these tariffs were going to be implemented, and then they went away, and we had this rally, and then I think it was 2 or 3 weeks ago, there was a court ruling that said the tariffs were illegal, and the market sold off on it, which is the exact opposite that it did in April. So I think at the end of the day, it's the uncertainty that it causes that's the main issue. But one of the things and concerns that came out of that was we were going to have massive inflation. Um, well, this is the charts for both CPI and the producer price index, which is PPI, going back 10 years. And what we can see is that these are not trending higher. I don't know that we can say they're trending lower, but they're certainly not trending higher. And they're kind of just going sideways. So if we were going to see any type of massive increase in inflation based on tariffs, it is not showing up in the data at all. Now, I'm sure there's some people saying, well, CPI doesn't track things accurately, and the inflation that I'm seeing in real life is much different. Not disagreeing with any of that, but for the purposes of what the market is looking at in terms of measuring inflation, this is the gauge. And right now, things seem to be kind of flatlining, so to speak. And then you look at the labor market. So last week, there was a pretty massive reduction in non-farm payrolls. It was 911,000, almost 1 million jobs over the past 12 to 18 months. Now, I think people saw the number, it was kind of a headline shock, but then they didn't realize, this is data that is over a year old. So it's not necessarily, corresponding with today's market. But if we look at the labor situation, you could argue that you're seeing a deterioration, small deterioration in the labor market. Certainly, if you take it back to the beginning of 2022, I mean, I think anything that comes out of post-COVID is I don't want to call it worthless, but it's pretty much worthless. Just because you had the rebound effect of so many jobs being lost because people couldn't work. But as we got back to a little bit more normalized environment, what you're seeing is this purple line is headed down, and then you've got this orange line, which is the unemployment rate, starting to tick up a little bit. Now, 4.3% unemployment is not a massive number, but coming off a 3.5% unemployment rate, as that starts to move higher, and the non-farm payroll number moves lower, that causes a little bit of trepidation in the market for interpretations of labor. Now, when you get into recessions, the unemployment rate is going to spike pretty significantly, and that non-farm payroll number is going to be in the negatives pretty consistently and for a sustained period of time. We are not quite there yet. 22,000 is not a very big number either. But I think that, from a trend perspective, this is probably the thing to pay attention to going forward, because as we worry about recession as the ultimate kind of bad news for the market, here are some other indicators going back to 2020. You've got employment, which we just looked at. You have industrial production, retail sales, and then real income. And you can see on this chart, these have all kind of flatlined over the past, we'll call it 2 years. In a recession, you're going to see these rolling over and rolling over pretty substantially. So we haven't seen that yet. Doesn't mean it can't happen. Doesn't mean it will happen. But if you look at the data in real time, you're not really seeing anything right now outside of some weakness in the labor market that would tell you a recession is imminent. Now, where does this leave the Fed? Because a lot of what we've seen in the market, I think, is being dictated on the idea that the Fed is now going to start a rate cutting cycle. And I don't have the odds in front of me, but I want to say that odds of a September rate cut are close to 100%. Dan, is that right?
Yes.
Okay. So the expectation is that the Fed is going to cut 25 basis points in September, and then what they do for the rest of the year is kind of up in the air. But when we look at real rates being what you can actually earn over the rate of inflation, and again, inflation measured by CPI. So this goes back to roughly 2005, right? And what you can see is before then, real rates were either negative or they were right around that zero line. But what we've seen is we've been at a kind of a 1.6% real rate here for going on close to 2 years, and that doesn't seem like a lot. But if we were to take this chart all the way back, what you'd see is that this is, I guess we could consider this somewhat restrictive in terms of the economy, and at some point you would expect that either this real rate needs to come down or it's going to have an effect on economic growth. So the Fed has been comfortable leaving this real rate where it is. I think going forward, how are they going to interpret that? Because when Chairman Powell was giving his testimony at the Jackson Hole Summit, a lot of people interpreted what he said to mean that the Fed was going to worry less about inflation going forward and more about the labor market. And if that's the case, they may not target real rates the same way that they have in the past. Now, if we make the assumption that we're going to get the rate cut in September, what does that look like? So historically, rate cuts have been bullish for equities outside of a recession. That last part is so important when we look at this, because you can see on this chart, if you have no recession, which is the light green line, rate cuts are a good thing. If you have a recession, it is not a good thing. Now, the hard part is you can see here, this is, we'll call it 40 days after the first rate cut. The trajectories are not that different, but after that, it becomes very clear that the two paths are not similar. And part of that is because in a recessionary environment, the Fed has to play catch up and cut rates aggressively, which is, is not something we want. We've shown the chart before that kind of shows the pace of rate cuts matter too. Slower rate cutting cycle, better for markets. Faster rate cutting cycle, not good. So based on the prediction that we're going to get one rate cut in September, and then it's kind of nebulous around the next 6 months, from a market perspective, that would be a quote unquote good scenario. But again, these rate cut, forecasts move very quickly based on the data. And then finally, earnings are going to drive stock prices at the end of the day. The earnings projections for this year and for next year still remain very strong. Both years projecting double-digit earnings growth. So from when we talk about valuations and concerns, yes, parts of the market they have elevated valuations. There's no arguing that. But you have earnings projections that are maybe supportive is a strong word of those valuations, but certainly providing some level of validity to what we're seeing in terms of the market, valuations in certain areas. So let's walk through the three economic scenarios that we may see over the next 6 to 12 months and how that might affect portfolios overall. So people love to put percentage probabilities on things. At the end of the day, I think they're just pulling numbers out of thin air. So we're going to list these as our expectations for the probability of these things happening, but I'm not going to put a number on them. Our base case, we'll call it, is kind of a softish landing. So you have economic growth that would remain stable. You have a Fed that can remain judicious about the pace of cuts. All right. So they may not have to go in and slash rates. They can kind of take their time. I'd say inflation remains between 2 and 3%. Historically, their target had been 2, but if the expectation is they're moving off of that a little bit and they're willing to go with a band, I think 2 to 3% is reasonable. And I think at the end of the day, this scenario is probably the best for both stocks and bonds as a combination. And it's probably similar to the market that we've seen in 2025. I mean, you're going to get growth probably leading the way, but there's other areas of the market that can still participate. Even this year, value small cap has lagged a little bit, but it's still up high single digits. So in this scenario, I think everything can continue to work. Doesn't mean there's not going to be volatility in between, and nothing in the market is a straight line. But I think this scenario can be very positive overall. Now, next is you get a hard landing. So this is just your typical recession. You'd see aggressive rate cuts. You'd likely see deflation as opposed to inflation. Now, if you had inflation along with bad economic growth, now you're talking about stagflation, which is the worst of the worst scenarios. But we're not seeing that quite yet. Recessions are going to be positive for bonds, and they're going to be negative for stocks. That's how it's always been, and that's probably how it will continue to go. Defensive value is likely going to outperform growth. So your established dividend payers are going to be areas that it's not that they're going to be positive in a down market, but they could be down less than what you would see with your higher beta or aggressive growth stocks. If you go back to the chart that Dan showed earlier between low volatility and kind of high beta, that relationship would certainly change. And then lastly, and when I say percentages, I would honestly put the hard landing and the perfect landing very close to each other. I think the softish landing for us right now is probably a large base case. But the perfect landing is you have economic growth that just turns around and booms as rates and inflation move lower. You have manufacturing returning to the US. In that environment, you're going to have things like cyclical value over growth and small cap over large. That would be an environment where returns could be very, very good, but it's probably going to come from areas of the market that haven't seen those type of returns for quite a while. But again, between the hard landing and the perfect landing, we're not seeing data that corresponds to either one of those. I would say things right now kind of remain in that softish landing camp. So, to kind of summarize all of this, I would say, we're still in an environment we feel like equity returns can be good. We're not oblivious to the risk that we're seeing right now, but based on the data and what we're seeing right now, we still think that there is room for positive growth through the end of the year. So, as always, if you have questions, comments, concerns, please reach out to your advisor. We're happy to hop on the phone or meet in person and go over those with you. But thank you for joining us. Now that we're outside of the summer months, we're going to try to get back into a little bit more frequent schedule with these, and look for the next one in about a month. And if things get dicey before then, we'll certainly change that schedule and look to be in communication with everyone. So again, thank you for joining us, and enjoy the rest of your day.